Thank you for everybody that's joining us this week from around the country for a pro perspective, the insider's look at all things commercial real estate. I'm your host today, Yannis Papadakis, business development manager at Crexi in our auction department. And we're thrilled to have back with us our very special guest, Brandon Hanna, to continue our talk about all things in the drugstore space. And for those that missed it, just a little reintroduction. Brandon is a founding member and managing partner of Encore Real Estate Investment Services. And alongside his partners, Brandon oversees a team of seasoned investment professionals that focus on advising clients in the acquisition and disposition of net leased and multi-tenant retail assets throughout the United States with a storied career. And last week we started with a little bit of your history. We both started working around commercial real estate at a very young age. You talked a little bit about transitioning into brokerage and what that looked like for you. And I'm going to open up the floor to anybody that has questions for Brandon, drugstore related, retail related. There is a Q&A feature of Zoom. We've got a chat feature and a Q&A. Go ahead and pop your questions into the Q&A, and we'll answer them as we get them, as we continue our discussion on the net lease drugstore space. Now, Brandon, let's pick up with where we left off last week. And can we talk a little bit about what is happening in the mom and pop drugstore world post-COVID? I know that we had seen for a while Rite Aid was weakening for a bit, and now it seems that COVID is kind of giving it a shot in the arm. What's happening to the smaller drugstores that are out there in the marketplace right now?
So Rite Aid in 2016 was a chain that had a little over 4,600 stores, and there was an acquisition on the table, as you know, and many of you who are listening in or were aware of, whereby Walgreens had a bid to buy the entire company, but the FTC gave a ruling that they could buy half of the stores. And so Walgreens took a big bite out of their Southeast, Northeast, and East Coast stores. And it was around 2,200 stores that they took over. So Rite Aid essentially became, they were always at number 3, with CVS being in the lead, and Walgreens following thereafter. Granted, Walgreens has a larger store count, but just given their acquisitions and the way they expanded, put them in second place in terms of the running, cap rate and valuation wise. But Rite Aid downsized to a 2,250 store count chain. But what's valuable about that is I feel like that gave Rite Aid from the perspective of control in terms of operations. They were a lot more they were a lot more flexible in terms of their ability to pivot. Given what's transpired as it relates to COVID, it's proven this theory because they have a new image. They initially went out with their wellness remodel where they incorporated the clinics and whatnot, and then now they have this new image where they've got all the new signage going on. A lot of their stores, their landlords have received letters. If not, they will receive letters. They're spending a lot of money in their stores. But that being said, they see the value in image updating. Just because every 10 to 12 years, you see a lot of these corporations with updated image. You've seen it with CVS where they've added the heart logos to their signs. You've seen Walgreens where they've added, certain, drastic color changes into their interior stores. But it's always important to see these corporations invest in their stores, because a lot of these stores, the landlord responsibilities are nominal, whereby it's limited to roof and structure, or in a lot of cases, they're absolute triple net, so they're true coupon clippers. So when these tenants are using their own dollars to change the signage, it's a viable sign that, they're ingrained. They still have a very accurate pulse on the industry. But that being said, a lot of the Rite Aid stores To answer your question, they had drive-throughs, and the drive-throughs were important. A lot of the mom and pops today, I'm seeing a lot of deals where Rite Aid, CVS, and Walgreens are buying the smaller mom and pop shops out because they're actually calling back Rite Aid, CVS, and Walgreens, depending on who made them an offer to buy their script business. Because post-COVID, these were mom and pops that didn't have drive-through, footprint locations that were on hard corners, main on main. And even if they were in hospitals, the hospitals are essentially shut down in terms of, the local pharmacy that was in that hospital, because you cannot even visit your loved ones in the hospital nowadays. So that's another scenario whereby the mom and pop business has been severely impacted, primarily due to the fact that, not only the restrictions for the pharmacists that are operating in the hospitals, but also, the concern from the consumer as it relates to walking into the store, not having a drive-through. And so the drive-through component is a paradigm shift. It's proven to be one in this space. So, that being said, thankfully, all three companies, their business model is to have, the drive-through. And it's a big component that I consistently advise when I'm selling drugstores. It's one of my, I know I talked about it last week, but it's one of my major boxes to check. Is
Right.
it a prototypical footprint location with a drive-through? Because irrespective of the fact that, we're looking at it from a drugstore approach, but if that drugstore was ever to vacate down the line, you have the ability, you have a broader audience for a backfill, if you want to call it that.
Fantastic. And to our attendees, if you missed part one that we did last week on this topic, you can email me. I put my email in the chat, Yannis@Crexi.com, and I can send you a link. Also, if you missed part of this or have to leave early and you'd like a link to this one, I can send that to you as well. We do have some questions that have come in. That why don't we start answering those? We've got from Don Maddox. What is the typical brokerage fee and co-op deal, say in the 4 to 6 million range that you're looking at?
That's a great question. There's going to be a lot of brokers, right, that I'm going to get some emails from following this question. But this is the thing, operating, just from experience, having exclusively listed and sold billions of dollars worth of real estate, you understand that there's a market fee that is, it's a market standard approach that a lot of the, avid investment practitioners utilize as it relates to call it, basic commission structure for a drugstore. Because every product type is going to be case by case, multi-tenant, irrespective if it's a multi-tenant anchored center that's anchored by a drugstore, it's still going to be a little bit more hands-on. A lot of times the drugstores, they are the single tenant net lease properties. And there's one lease, one environmental, one title policy, one survey, one property condition assessment. So a lot of times the owners will use that as a rebuttal, but the market fee between a $4 to $5 million price point deal, it should also be tiered, because there's CVS's, there's Walgreens, there's Rite Aids. There's a buyer pool for each different product type. And that being said, I think the fee gets tiered, predicated on which product type. So it is really truly case by case. But if Encore was to take a listing in that range, let's say it was a Walgreens and it was between a $4 to $5 million deal, depending on how much lease term, it's, that question has so many moving parts. Let's just call it, there's not too many 20-year deals today, but let's say it's a 10-year deal. And, depending on the underlying landlord responsibilities, because that's also going to play a role. But you'd be looking at, I'd call it anywhere from 3.5% as it relates to a deal whereby the brokers would fully cooperate. Encore has a reputation around the United States of America where we pride ourselves on engaging the brokers to work our deals. We never want a broker to have any hesitation to pick up the phone and call us when they have a really good buyer, because they feel like they're going to have to ask if we're fully cooperating with them. So that being said, we've time-stamped and dated our reputation and built our firm around that type of a sentiment, that type of culture. And a lot of the brokers throughout the country respect us, and it's vice versa on our end. But a 3.5% fee, call it, would be the market. And if we were to sell the deal ourselves, we would likely take a discounted fee, in that regard as well, where the fee would come down to say, 2.5%, because there's not an out of state broker who's cooperating with us, because we would be representing the buyer ourselves. So that incentivizes, the seller, and he realizes that that could be a possibility because of the fact that we have such a sustained track record in the space. And the individuals we're dealing with, they're also high-level individuals, very sophisticated. So we never want it to be about the fee, because it's not the case. But keeping in mind that the commission is the most viable investment with respect to these deals, because I'll tell you why, Yanni. And you've been on this side of, because you were at Marcus and Millichap, and when we were, trained in the business, we were told from the onset, granted we were lucky to have good mentors, the commission it's so important to acknowledge value. When I say acknowledging value, I'm talking about a guy who's, let's say he's based in, New York City, and, here's a broker, he's in Long Island, he's pounding the pavement, he's working his, his client list, and his book of clients, generates a lead where somebody's in an exchange, they've got $5 million, they just closed on their down leg, which was a multi-tenant center, and they're arbitraging looking for a single tenant coupon clipper. That broker's sophisticated, he's going out and canvassing the market, and he comes across your Walgreens deal. There's not a lot of guys like him in the marketplace. You see what I mean? I understand people look at this space and they say this is a gigantic space. You know what? It's not, because it's really a very tight-knit space where everyone knows everyone, and you have to be very careful about how you preserve the integrity of your reputation. And
right.
That being said, that component of commission, when that broker calls you and says, hey, what's your fee on this deal? And you tell him, it's a below market fee, he's going to come back and say, these guys are not being realistic. And a lot of times it's not worth the time and value, and where he wants to go out and, really sell that deal to his client, he's going to show the deal to his client, but he's also going to say, there's other deals that I'm going to show to my client as well. Not to say that the broker's fee motivated, but it's a function of, having that, sentiment where it's equal and fair for the broker's time and value. Because when you have a buyer that has the ability and the capacity to close within 30 days, I always tell everyone, motivate the brokerage continuum to work your deal. Motivate that, because that's how you're going to get the most eyes on your deal, where you're not only leading the market in terms of pricing, but you're leading the market in terms of compensation to the agents who are, we're the matchmakers. We're like that liaison that is a critical component to the process.
Right. Right. And I don't think that you would ruffle any feathers by suggesting that brokers might be fee motivated, right? Even on Crexi's platform and our search filters, you have the ability to search for deals that are front facing, offering a co-op fee, and it's a feature that gets used. Brokers are, all things being equal, if I'm working 3 deals, and one of them's paying me twice what the other 2 deals are paying me, I might prioritize getting that in front of clients.
Right. No, and this is the thing. It's the 3.5 that I quoted, that deal, I'm looking at it and I'm saying, double net, there's moving parts. We're going to have to do a lot of due diligence, a lot of, hand holding. But if you told me like, hey, it's a, $4 or $5 million Walgreens 20-year absolute net true coupon clipper, people are going to tell you the market fee is 2%, to 3%. But, my position as a drugstore practitioner is to ensure that the sellers understand there's a lot of inventory on the marketplace today. If you were to, do a count of how many CVS, Walgreens, and Rite Aids are on the market, and I know we have those numbers, the marketplace is very competitive. So in order to, stand out, there are ways, and that goes to, to the second topic, which is, in our question log that we put together, how do you advise new agents that are coming into the business, into the drugstore space, as it relates to, what they should look for? Right. And, my answer to that question is, don't just shoot from the hip. That's the worst thing you could possibly do. When you don't know the answers, you can't lie to people. You just got to go back to your seniors. You tell the individuals, I don't have the answer. I will seek the opinion of the managing partners or the senior VPs, and I'll circle back to you within a day with an answer. Because it happens a lot in our business. And what that does for guys like myself and the other peers of mine in the industry, who are the leading guys in the industry, and there's a handful of us, and we all know who we are, it makes our job a lot harder because expectations are being set incorrectly. And that to me is a major, factor whereby it causes a lot of confusion in our industry. It's a very important topic that it's very sensitive to me. There's a lot of new brokers that have entered the market from 2014 until today. Right. Because, that interest rate environment, the 10-year treasury started dropping, and people were coming out of, industries that were severely impacted from the Great Depression of the 21st century. And with that being said, a lot of these brokers wanted to expand their horizons and get into the investment arena, which is completely fine. You never want to discourage anybody from doing what they think would be good for them. But what ended up happening in our space was there was a lot of misinformation. And then when you come into a space like the drugstore space that's so, it's so specialized, it requires, practitioners who have sustained backgrounds that understand the underlying intrinsics of these deals. There's so many moving parts. But that being said, I would say to the guys who are coming into the industry or who want to come into the industry, partner up with the right mentor for the right product type. And that being said, the right product type is something that they'll figure out, I'm sure, prior to entering the industry. But if, you think you're going to come into the industry and just look at comps, there's a lot more that goes into these deals than just the comps. I mean, I look at comps every single day, but I'll guarantee you that a store that's doing 17 million in sales and is reporting it, and that store is going to command an absolute premium. Right. And that store that's reporting 7 million in sales, it's going to be and has the same amount of churn. The cap rates are going to just be different generally because of what I just mentioned. So don't just be eager to chase a paycheck. Be eager to learn the industry so you can become a professional where people, seek your guidance as opposed to you just telling them what they want to hear. I'm not in the business of telling people what they want to hear. It's just not what I do.
And, it's funny that you say that too, because you talk about, the comps are something that you're always looking at. And the truth is, comps becomes a way of life. When you're tapped in and you specialize in a product, you're seeing all the deals. Like my partner and I, when I was at Marcus, we would just play what's that deal every day where, hey, have you seen this deal? And just test each other's knowledge on who listed it, what was what was it originally priced? Where is the reduced price now? All that fun stuff. Because you really have to be paying attention to everything that's coming on. We do have a question. We have a couple questions that are in the same vein that we'll jump to. And Mahesh Varma asks, where do you find your comps? Mahesh, you can find comps on Crexi's intelligence subscription. We've got tons of comps on Crexi where you can find them. You can send me an email after this if you need more information on that. A couple questions in the same vein here. So we've got from Myron Fezchak. Thanks for the webinar. How are pharmacies doing during this market? Is there increased risk for lease renewals or failure to renew? If a lease is not renewed, how else can a large former drugstore be monetized? And then within that same vein, we also have a question about what is the life of a building after a drugstore, right? I think that a lot of drugstore owners want to know, if I am looking at a vacant box here coming up soon, if they fail to renew, what are my best options?
Fair enough. So we'll touch on the first question as it relates to how drugstores are performing during this current, pandemic and economic crisis that we're, living through. The short answer is they're labeled essential for a reason. And, Walgreens has been around since 1901. That's, 119-year-old company. So that being said, there's a lot to be said about companies that survive 100+ years, or call it product type, right? This specific product type, the pharmacy product type. Because they're essential, that helped substantially. Because of the fact that they were a big part of, this economic plan to introduce all of the testing for the COVID-19 patients, that was very much important. And, third, they are pivoting to where they realize that they are going to be heading in the direction, in the space where there's like 2 or 3 major companies, you have a tendency to look at these companies, they follow one another. They follow the same patterns. And the patterns that I see taking precedent now is CVS is leading the pack because they spent $69 billion to buy Aetna, and that deal was approved, I believe it was the second quarter of this year. And that being said, you're seeing, the CVS try to monetize the front end space and incorporate those clinics or the offices where the patient or the customers can sit with the doctors. And you'll see Walgreens and Rite Aid take that aggressive approach as well, because again, they follow the same pattern, but how they're doing now, they're doing a lot better. And I mentioned this on my first call. When I was in the space where, and everyone was, pretty much, we all had the same agenda. We were, stay-at-home orders, right? And just leaving the house and going to the drugstore or going to the grocery store, it was a breath of fresh air. You missed the experience. You were like, I'm walking down the aisles. Me personally, I'm a big foodie, and I jam up on the junk. But I always find the drugstores to have all the best candies, by the way. For some reason, like I tell my kids, I'll take you to the drugstore instead of taking you to the gas station or, whenever they're good and I'm, treating them to candy. But you get to find the coolest candies at the drugstores. But, nonetheless, the reality is the market, it created a scenario for the drugstores whereby they were propelled back into, top 5. They were definitely slacking in terms of sentiment. Me personally, I always look at this industry, and I had this conversation earlier with one of my mentors who was one of the former, VPs of the major drugstore corporations. He signed over 2,000 leases, and drugstores are going to evolve. Absolutely. It's clearly evident as it relates to how they test out certain prototypical formats, like Walgreens with their Mini Cooper model, and they don't have a drive-through. Again, me personally, I see that space getting impacted now. They feel the repercussions of not having a drive-through. So I don't have any further information as to their expansion plans, but just from the outside looking in and just hearing what the mom and pop operators are saying as to how their business has been substantially impacted in terms of their sales because of this lack of a drive-through. I see them, taking a step back with that approach. And I see, something that is very critical to the marketplace. And everyone on this call, I want to make something very clear. When you see drugstores like CVS exercising new 20-year lease extensions, and that in and of itself is a gigantic indication that the industry is not changing tomorrow. It's not changing 3 years from now. It's these guys are signing 20-year lease extensions. They sign 10-year lease extensions. Granted, there's a discussion and negotiations, and there's a give and take and rent reductions. However, you look at these extensions, 20 years through, say they extend through 2040. I understand we've got the threat of, online. We've got the threat of the underlying, pill packs of the world. However, something so powerful such as a 20-year extension should give the investors the level of comfort that these guys are here to stay. Yeah, they're going to have, again, new introductions, or they're going to conform to market conditions, but overall, long-term perspective, they're here to stay. They're an essential component to the consumer. And that being said, another thing I'd like to touch on for the viewers is a lot of viewers ask how the store performance is doing. I think what's important with respect to store performance, whenever you see recent lease extensions, one thing I'm a big advocate about, and a lot of the drugstore professionals, see it as well, is there's not a lot of new drugstores opening up. They're not expanding. It's just the drugstore wars are over. Those were the days of old where the drugstore retailers would pay top dollar for a corner, and everyone would say, well, look at their rents. They're paying 25 and 30 bucks a foot. However, yeah, they secured the best real estate in town, the best corner real estate in town. And, they're high volume generating locations, but in a lot of cases, yeah, there was oversaturation. We always go through that overbuilding, trap.
It pulls back a little bit.
Right. And that's where we're at right now. Exactly. We're in that phase where they're pulling back, they're testing different models, testing different concepts, but you still have those backbone generating stores for corporate, those high volume locations. But touching on the sales component, we have the ability to, just through our experience, a lot of times there's certain stores that report, there's certain stores that don't report. But when you look at stores that have signed new leases for 20 years, with all due respect, in 20 years, that store can, the sales volumes, they're going to, it's at this point, there were enough for them to commit. You see what I mean? So clearly, it wasn't like they're committing for 20 months. They're committing for 20 years. So a lot of people have reservations when they can't verify sales. Personally, I think that's just not a good match buyer for a drugstore deal. I think that's a buyer who's got too many holes you could drive a truck through, in their expectations. And
Right.
I'm a big advocate on piecing together, deals and matching good buyers with good deals. It's actually fun for me. I enjoy it, and that's why we've got a good, revolving list of, roster of buyers and sellers in our, Rolodex, thankfully. And, that being said, I like to make, everyone aware that you just can't change it. If somebody signs for 20 years, that in and of itself should be the one thing that you look at. And then, there's others, obviously, such as a corporate guarantee and, condition of the lease. Is it a triple net or a double net? And, touching back on what the brokers, new brokers in the business, please, guys, read the leases. Don't just listen to a seller who says, hey, this is a double net lease. And, read the leases, because what happens is a guy like me, and then there's other guys in the industry, we have to bear the brunt. We have to get the punch in the gut and, look at clients and say, sorry you had that experience, but that's not how we operate. We're going to read the lease. We're going to make sure there's no holes you could drive a truck through in those leases in terms of their carve-outs and caveats as it relates to landlord responsibilities, not just roof and structure, it's parking lot replacement. And then, false starts, That's not how we operate. It's not
Right.
on our list. I don't tolerate it personally. My partners don't tolerate it. And thankfully, it's how we train the guys at the firm. But I had to get that one off my chest.
No, and I appreciate that because, oftentimes as a broker, you got to wear a couple of other hats before you actually get to, wear the broker hat. Sometimes you got to be therapist a little bit for a principal that had a terrible experience with somebody else last time around, and you got to, talk, explain to them how things are going to be different and really clean up after somebody else's mess. We actually have a very enthusiastic participant that has a question, and we're going to test out your on-the-fly underwriting skills. We've got Dan, who is saying, I've had a Walgreens with 7 years. Sales are 12 million, and I'm assuming that's reported sales. Landlord wants 6.6 cap. Is he realistic? 7 years left, a bunch of options, no drive-through. Dan, we probably need to know if it's double net or triple net.
Right. Double net, triple net. And it does not have a drive-through. So is it an inner city location store? Because that's a high volume store. And the one thing that concerns me, not to cut you off, Yanni, is when you have such high volume and you don't have a drive-through incorporated, depending on whether or not they're located in areas where there's moratoriums that don't allow for drive-throughs, we need to verify that, because that's going to play a big role in terms of what, our ability to achieve that cap rate. It sounds about right from, the bones of it, but I got to dig deeper into also verifying those sales, because I know Walgreens, the way they report, their gross receipts section in their lease only requires them to report a fraction of gross revenue. So there's a model, a formula where, you can incorporate it, and we can help a lot of people out to determine a fair estimate of gross revenue from their sites.
Right. And, in terms of sales, we have a couple questions here too. We had somebody ask, how are you obtaining individual store sales? And just the short answer there is that you'll have it in the lease that the sales are reported. And
right.
then how determine
the store sales, it is per the lease, correct? However, because of the fact that we attend a lot of the conventions, or we used to attend a lot of the conventions, and we'll attend them through Zoom if we have to. We'll always figure out a way. It's not the end of the world. So that being said, we have relationships with these organizations, within these organizations, and we're able to decipher and differentiate, just from the feedback, viability of a subject site for the corporation. So if you have those questions, feel free to reach out, definitely. And then touching back on that last Walgreens deal, I'd like that person to call, because I'm curious just to see, why there's not a drive-through, like I said, because of the moratorium in place, or if it's an inner city location. But if they reach out, I could give them, an accurate assessment of what the cap rate will look like, and then where we expect it to land too, for what it's worth.
Right. Dan, go ahead and send either myself or Brandon an email. Both of them are in the chat. And we'll see if we can get you a more fine-tuned pricing for you. A ton of questions that are still rolling in here. Multiplier. So let's say you get a Walgreens, store sales, or at least the reported store sales. What's the standard multiplier that you're using to try to, ballpark the total sales?
It's a good question. It's a good question. It's I think it's case by case. There's multiple models and formulas that have been brought to surface, but they all come to a pretty close range. A lot of people use a multiplier of 3. There's people that use multipliers of 3.5, and then there's people that use multipliers of 4. However, we look at, certain components that enable us to, decipher, like I said, and differentiate how we can incorporate those formulas and those models. But, that being said, it also depends on the gross receipts section of the lease. A lot of these Walgreens stores were former Rite Aids and former Eckarts. So there are exclusions as well that need to be taken into consideration. So the formula I just mentioned doesn't even apply. So it's, like I said, it's a conversation that needs to be had on a separate note where we have the lease in front of us, and then we could advise accordingly. But as you could tell, we're very well versed in that regard of, getting close to, setting expectations on how these units are performing. But most importantly, you get the basic model of stores that will extend their leases. And when they extend their leases, it's a very, strong indication that these are, tenants that are, they have a vested interest in these locations. They made it. They stood the test of time. If they stood the test of time, they've been there 20 years, the likelihood of them on an extending, it's not because of only market share. That store is a producer for them. It's a store that's generating revenues where the bottom line EBITDA is viable, and they have their own mechanism and formulas that they dive into before they approve any lease extensions. Granted, these guys still have a very accurate pulse on what they're doing, clearly.
Now we've got from Jesse Krieg. I'm located in Pittsburgh, and currently most of the banks are not willing to lend on any Rite Aid properties as they view the brand as high risk. What are your thoughts on this? CVS and Walgreens lending is not an issue. Have you seen that?
You know what? I've heard that objection since I was introduced to the business.
Right.
And I've sold probably, more Rite Aids, than 99.9% of people in the world, for what it's worth. We always seem to have our repeat lenders. Certain lenders have a different appetite, different requirements. Borrower strength plays a role. I mean, we sold 4 Rite Aids in California, and the lender, came out of the other side of the country. So it's the relationship with the lenders.
Right.
We have a Capital Corp department. Encore's Capital Corp director is Brad Moncton, and I've known Brad for over 10 years. He is one of the foremost practitioners in sourcing debt for capital markets, for our sellers, for our buyers. And no, there are deals. Rite Aid is definitely. I was actually on a conference call with one of the largest banks in the country, Wells Fargo, and they actually happened to mention that Rite Aid is looking pretty good because their debt on the books has become far more lower leverage than when they had all of those stores prior to Walgreens, in my opinion, doing them a favor because they took a big chunk of the stores that they actually had to close down. But happy to help that investor as well. If you want to pass along the contact information, we can get him a debt quote within 48 hours on his property. And like certainty of execution, not a fly-by-night debt quote.
Right, right. So Jesse, go ahead and send Brandon an email or myself after this and see about getting some debt for that Rite Aid for you. Okay, up next. Let's see. Wow, a ton of them. I'm trying to pick the questions that are most repeated, so that way we can kind of scratch most of them off. How about Bradley's question here? What lease concessions can you anticipate when the lease is coming due?
I mean, it's a great question. It's all predicated on, where that rent is relative to market. It's, what the location looks like. Is it a primary, secondary, tertiary market? Where the most, where the closest competitor is? How many of the stores do they have in that immediate trade area? We do all of that recon for our clients, and we help them out with, walking them down the aisle.
You take them through the process. So like you're a drugstore owner, you just got a letter from your tenant saying, we need to renegotiate the the lease rate here coming up soon. What's your first step? What are you doing? Are you giving you a call at Encore and saying, hey, I just got this letter. What do we do? Like, how are you counseling landlords in that position?
We're a one-stop shop. Interestingly enough, we do, have our, general counsel on board, and we've got the experience, the background where we have fielded so many of these questions and gone through so many lease extensions. We know all of the boxes to check, but, we would immediately, step into the shoes of, the owner and have the owner grant us, the permission to, speak with the tenant. And that being said, it becomes more of, a dealing with the tenant. And from previous experience, a lot of these tenants, they know us, and we're able to navigate through the course of the continuum and the process and find a fair meeting grounds. But to the extent where we've exhausted all of the, the underlying boxes that need to be checked, right? It's not, and sometimes tenants will come out and say, hey, this is what we need. And they will not back down because they also do their recon. Like I said, I give them a lot of credit, but it's a function of just being able to have somebody who's rational and practical advising you, who has the real-time experience, so that at the very least, your expectations are being set properly and you're getting the best deal possible.
Right. Now, we've got a question here, and this is always an interesting one too, because I'm sure this affected a lot of people as Walgreens did their, store pickup from Rite Aid. What is WAG's strategy for the dual stores in the same market? What goes into that decision when they say, okay, we're going to keep this store operating and close this one? Is it strictly down? Does it come strictly down to sales? Are we looking at, what has just the hands down better real estate within that market? What goes into that decision?
It's at certain times it's like an anomaly. I'm like, how did they close this store down? But then there's certain cases that make a lot of sense when, you've got like a median that's put in, and now you only have a right in, right out. And so you've got, restrictions, and, things change, right? With respect to the underlying, signalized hard corner main on main locations. These are like the highest traffic locations in town. And, there's a lot of eminent domain that happens, but, at the end of the day, that coupled with, like what I mentioned earlier, certain underlying factors, with relation to, how many stores were open in that market. Sometimes they have stores that are anchored in shopping centers that are doing better than their freestanding stores. And the reason being is because that shopping center is just like a, destination point, and it's got a mega, reputation for being a big traffic draw. And we've seen it time and time again where we're like, wow, they did a freestanding prototypical footprint, and then they had a location in a shopping center, but the location in a shopping center had a drive-through as well. So yeah. A lot of times people would go to the, tanning salon, or, they'd go to the restaurant, and then they'd leave the restaurant and it's right there. They just go right through the drive-through in that shopping center. They're not having to go out, battle the traffic. You see what I mean? So there's a lot that goes into, how and why tenants decide to keep locations open or shutter them. But, one of the primary factors, in my opinion, is, really at the end of the day, their market share too. It's important, but I've been proven wrong in the past. So it's, every site is, honestly, Yanni, the right answer is every site is case by case. So have somebody who's an expert, look at it, set your expectations. Nobody has a crystal ball. Whoever pretends to have one, run away from them. But, we could tell you that it's, there's been some pretty interesting deals that are still open to this day. I saw one today. Somebody sent me a Walgreens, and it was like the lowest price point Walgreens I'd ever seen. And I chuckled, and I looked at it, and, lo and behold, it does not have a drive-through, but it's like the only game in town. It's like really like the destination point location. But, so that's the thing. It all boils down to, what purpose does that location serve for corporate?
Got it. Now, okay, let's see. This might be a good one. This is why don't the pharma companies own the real estate? Why do they prefer leasing instead of owning the space?
It's a great question. The short answer is, why doesn't, Target, Walmart, Kroger, um, CVS, McDonald's, Chick-fil-A, to the people on the West Coast, In-N-Out Burger. Granted, they own, as many of their locations as they possibly can. The short answer is the major corporations, they're in business to grow their business, right? These are Fortune, 5 and Fortune 500, companies that are in the business of continuing to invest in their business. And for them to, to own their own real estate, what ends up happening is they're going to tie up a lot of cash into the real estate. They're not real estate people in that regard. Yeah, they have experts who understand the real estate economics, but their primary focus is to operate their stores. Yeah. So from the operational aspect, that's the primary concern for these companies. And, their secondary concern is the real estate, thereby, clearly, not having a vested interest in the real estate. But they, you'd be surprised. They have stores in their portfolio that are pretty neat. A lot of them, all three companies that, go way back to the 70s and 80s. And, but eventually they do, a lot of the sale leasebacks. And when those come around, it's important to, pay close attention to them, because there's not, the drugstores, in my opinion, the inventory will get more scarce down the line, because it'll trade hands, but there's not a lot of new stores being built at this time. And, I could tell you right now, the downsizing of the space, we've been going through it for the last 5 years. And so, it's possible that they might kick up as it relates to creating for, new construction prototypical footprints. Maybe there'll be smaller prototypes, for these corporations, but they'll have, drive-throughs clearly. So that being said, the best is yet to come. I always say that, you got to have hope, look forward to the future, but, don't ever veer off. Stick to your basic fundamentals. It's very important to see the value in locations that are hard corner, main on main. It's what the business revolves around, the drugstore business.
Now, I know it's very situational, but can, all things being equal, can you give us just a general cap rate spread between, the three major tenants, CVS, Walgreens, and Rite Aid? If, let's say, you're looking at the exact same deal, same location, we'll call it a 15-year triple net. What are you seeing in terms of cap rate spread between the tenants right now?
Again, it's all situational. It's based on the situation, the circumstances per deal. But me personally, I've seen one of the greatest, movements in terms of cap rates for flight to quality assets. And I see this space as a flight to quality space. Wall Street, look, I'm not a stock market, guy. I've been intrigued by the stock market, but I feel like that damn thing's a casino, right? It's like they got the cameras right on you. They know where, when you're reaching in your pocket and pulling out your notes, so they know your every movement. So I'm just a real estate guy through and through. I like, I like the, the intrinsics of the dirt. I like the fundamentals of, looking at corporate seals and how they rank amongst one another. But I consider that specific space that I specialize in a space that, I'm comfortable, recommending to investors and advising investors. And I call it a flight to quality space right now in the market today, because there are a lot of industries that are going to be severely impacted. There's a lot of product types that are already showcasing that they're impacted. Even opportunities that are nearby airports. I mean, I think United Airlines just announced that they laid off 18,000 people. MGM's laying off 18,000 people, Coca-Cola, 10,000 people. So, the economic repercussions, the shifts, it's like it's collapsing right right in front of our eyes. Not too many people are paying attention to it. So you want to have that flight to quality, safe haven, because the stock market could potentially be built on sand, right? So there's, that's why, that space is so viable. So the cap rates, I've seen the biggest cap rate movement, like a CVS in that regard. I mean, I could tell you right now, we set records this year. I sold a CVS in Staten Island, New York for a 4.56 cap. It was with one of my colleagues who was at one of the major brokerage firms. That was a $7 million deal price tag. That was granted it was in one of the boroughs and they have a high state income tax. When I asked the owner why he purchased that deal, he said, I'll look at another one like this. This is flight to quality. Right. He said exactly what I was saying. So there's a lot of people that are in this space that get it. And when you're hearing that same sentiment being shared, I don't think it's shared enough, but definitely the dollar stores, the tire stores, these, flight to quality.
You bring up an interesting debate that I've been having with brokers across the market, and that is, where do you feel safest right now investing in net leased? And it always comes down to today, drugstores and dollar stores. And, while, drugstores are, having a tremendous, pop because of COVID right now, looking long term, if, for your money in the next 10 years, what do you prefer to own, a drugstore or a dollar store? Do we see drugstores after COVID, kind of becomes non-existent in the future? Do we see them start to wind down again, being threatened by online platforms like Amazon? Whereas, a dollar store, Amazon can't compete with, the 99-cent goods, that you can walk down the street and get at a dollar store in some markets. So what are your thoughts? Where do you weigh in on that?
It's a great point. The one thing I always say is when government has a vested interest in a specific industry, don't fear it. So that, to me is a big driving force for the drugstore industry. I don't think they will go anywhere anytime soon. Yeah, there will always be threats, and there's always going to be, certain peaks and plateaus in the market where these retailers will thrive and they'll, move up the ranks, just like, apartments were, student housing was out of control at one point and everybody wanted to do student housing. And then, Section 8 apartments, which are still thriving and will likely continue to thrive. But, every, sector, every product type has within its product type, space has its, plateaus and peaks. And the drugstores right now, they've come back because of the underlying market conditions. They will cool off, absolutely, because there's a lot of extensions that are taking place, Yanni, because of the fact that, keep in mind, a majority of these stores were built in 1999 and 2000, and now their maturity of their initial 20-year term is coming, into fruition and coming into play, and they're negotiating for that new life, that new runway, that new runway that's being, put together of 10 or 15 or 20 years. So I think it's a long time. I see it as a long-term scenario. I don't see the dollar stores having the government involved in them. So to me, they are a business that services a need, but as it relates to their customer base, their customers, they have a lot of options. And when their customers have a lot of options, you see the trends, like where does the consumer navigate throughout the day? A lot of the consumers, navigating, revolves around the dollar stores and the drugstores. But when they're in the drugstores, they're spending more money.
Right.
And, because of the government aid and the, third-party prescription benefits. But the dollar stores, they're not, unfortunately, their competition too is, all of the grocery stores of the world. People, go to grocery stores, and grocery stores are gigantic now. They have everything. They're one-stop shops. So I think the dollar stores are worried more about the grocery stores than they are about the pharmacies, because the pharmacies have already pivoted.
Right.
So, that being said, and I'm not, downplaying the dollar store space. I'm a big advocate of the space, 100%. But it's just, it has to be at the right price point, right? I could tell you what a dollar store looks like to me that I think is overpriced, or one that has phenomenal fundamentals. And there's a lot of everything out in the market. And the same goes for drugstores. But I hope that gave you, indication where my mind is at.
It did. And, you're 2 for 2 on having more questions than we could possibly get to. This is probably one of the most engaged webinars that we've done, both part 1 and part 2. To anybody that has more questions about the drugstore space, I highly appreciate you coming and tuning in. You definitely decided to take advantage of the expert that we have with us this week. Please feel free to email Brandon. I popped his email into the chat there, and you can reach out separately with your questions. Anything about really, use them as a resource. Brandon, you've been a pro subscriber and a supporter of Crexi for a long time. We really appreciate having you on board. I know we keep getting, great feedback on the leads that, we're able to produce for you, and the marketing that you're getting with us. So, we thank you for your support, coming on and sharing your knowledge and wisdom with us. And to everybody else, appreciate you coming and sharing this important and timely topic. Please continue to tune in for future pro perspectives, where we're going to take more looks at the market from different angles. Brandon, I thank you for your time, and appreciate you hopping on.
Thank you very much, Yanni. Thanks for your time, and appreciate the opportunity, and looking forward to the future, and hopefully everybody gets the ability to have all their questions answered, if not just by us, by all of their experts. And looking forward to the next time. All the best. Thank you.
Hey, absolutely. Take care. And then to any attendees, if you missed part of this webinar or you missed part 1 we did last week, you can email me for a link. If you're interested in learning more about Crexi Pro's membership, or you want access to comps or data, you can email me as well. It's Yannis@crexi.com. Thanks, everyone, and see you next week. Take care.